Welcome everybody to the Middle Class Investor. This is Seth Martin, your host. It is Saturday, November 22nd, and we had another strong week in the market. Let's put the weekly chart up there and zoom in on that real quick. You can see that we're above this trend line here. This red trend line is the trend line that connects the 2000, the dot-com high, and the financial crisis high. And you can see we're firmly above that and in our resistance box, and actually firmly above that as well. So the market showing a lot of strength here. Probably going to see some sort of pullback, maybe back down to this line before we go higher. Not really sure. Not really sure. It's hard to say because this whole move has been so unprecedented that we had a pretty strong move back here like that. You can see this move right here. But that was after the 2000. That was after a very substantial pullback. This was nothing. This pullback here was nothing compared to this, and yet this move up, this thrust up, is about equal to this thrust up. So for the price action we've been getting over the last year, I would say this thrust up is fairly unprecedented, but it is what it is. We don't argue against the market, because if you argue with the market, you're going to lose money. So that's a good rule to follow. Don't argue with the market. So we're not going to do that. So let's look at some of the other. Let's look at the interest rate market, and then we'll come back and we'll look at that on a daily. You can see that yields are still kind of hovering around this 2.29 area, and again, they're kind of in a consolidation or a sideways pattern, and they could come up here and maybe pull back. I don't know if we're going to see any lower lows, but we could see it pull back further. The high yield market has really, it's the spreads in that market are really starting to widen, which means you're starting to get some, the liquidity in that market is starting to go away, and so that's probably going to make yields go higher, not go down. So we'll just have to wait and see how that plays out. It's hard to guess. This is the craziest market that I've seen since I've been watching it. So I don't feel comfortable calling it one way or the other. The S&P 500 also strong. I think I'm tempted to take this rising wedge off here, because you might remember that I mentioned once it breaks out of the wedge that it's got like a 90+% probability of going to its target, and you can see here it looked like it was going to retest the underside of this trend line and then maybe roll over, but it just kept on going. So I'm not sure we're going to continue to talk about this rising wedge. I really just have it on there just for because I've had it on there for so long that I'm tempted to just leave it on there for now. But I think it's safe to say that the rising wedge didn't happen here, because we got a clear breakout of the rising wedge, and then it got right back above it and kept going. So, and now we're actually, if you see here, we're actually above. You can see here we're actually above the higher trend line. So I don't know. we'll just have to wait and see. Let's look at, I think the most interesting market lately has been Japan. So here's the Japanese ETF, the EWJ. And the reason I think this, maybe not this chart, is interesting, but Japan is probably 5 or 10 years, at least 10 years ahead of us with their Keynesian experimentation. And I think it's starting to finally show that it's not working. If you look at the FXY, that's the Japanese yen. You can see what the government there has done to the yen. So this is all a result of doing their quantitative easing. Okay, so they've lowered the value of the yen to try to improve exports. The problem with doing that, the thing that nobody ever talks about is, yeah, you might have an improvement of exports, but your imports become more expensive, and prices in general become more expensive because you're devaluing the currency. So you're starting to see consumer prices really go up over there. You're starting to see consumer demand starting to fall. Their GDP is starting to fall. I mean, their economy is really starting to roll over. And I mean, I think we're at the very early stages of that. You can, whoops, that's Germany. Germany came down to this trend line. You know, if you connect these lows down here, connect this low with this low here, you know, Germany basically came down to that trend line and has bounced. So it looks like Germany's going to go up here and make a higher high, but we'll have to wait and see. It's hard to tell which economies are driving the global economy, and so they're all kind of you got the U.S. markets really elevated, and then you got these other industrialized countries. You can see this pattern here. Now this rising wedge looks like it's still got a chance, but again, we'll just have to see, because this looks a lot like the way the one for the S&P 500 was looking. So we'll have to see if it comes up here. So if it comes up here and comes up here like this, and then recoils from this, then obviously this rising wedge will have been a little bit better than ours. But if it comes up here really strong like ours and goes through this and actually over this, I mean, that's not going to be that's going to be a rising wedge that fails also. Whoops. Let's look at volatility. Volatility is another interesting. I think it's interesting because we had a pretty substantial pop in volatility. So that last run down was quite a bit of fear for the market, and yet it has basically almost erased the entire move. I mean, this was the fear pop up, and here's the lack of fear pop down. I mean, it's almost completely reversed itself. So that's another interesting thing that I have not seen. So there's crazy stuff happening in this market. I don't know if it's because, clearly the markets with the Federal Reserve are being manipulated. Probably unlike any other time that we've ever seen them be manipulated. I mean, we've got roughly $4.5 trillion that the Fed created out of thin air and bought, mortgage-backed securities, mortgage bonds in America, and U.S. Treasuries. And I'm not sure that's ever even happened before. I don't think that's ever happened. In fact, the Fed, it took 90-something years, 95 years, for the Fed balance sheet to get to 900 billion, and then after the financial crisis, it's gone from 900 billion to 4.5 trillion. You know, and the problem is, how does it ever go back down? You know, I think there's been a lot of talk about how the Fed has successfully navigated the financial crisis, but the problem is the balance sheet is still very large. So, you know, let's say that 900 billion is really more of the norm. How do they go from 4.5 trillion back down to 900 billion? I don't think you can really say the Fed has been successful until until they soak up all those excess reserves and get rid of them. So, you know, I'm not going to get into too much of that here, but suffice it to say, if you have any savings at all, and you hope to retire on it someday, you better hope that the Fed can get rid of that $4.5 trillion, or you're basically just going to get wiped out. We're all going to get wiped out with inflation. So now, you know, it looks like if you look at gold, and let's go look at gold real quick. Here's the dollar. You can see the dollar still very strong. Still hadn't eclipsed the high from 2011, but still really strong. Now, the interesting thing about gold is gold may have bottomed for the time being. So this is I was expecting it to come down here into this box, this support box, but this bounce is looking pretty strong. What I've been watching for is to see gold go back into. Let's zoom in on this because it's kind of interesting that. Here, I got this so you can see the values. Okay, that'll work. So you can see, you know, I've got this line drawn on here, and you can see gold has made a real strong run up to it, went through it, but look, it closed the week, you know, below it. So that's pretty interesting. But I think if gold can close above here, which I think the probability is that it probably will, I think you're going to see gold make a move probably up in, you know, north of this 1300, 1350 area. So we'll keep an eye on that. You know, and so gold has been, if you think about it, gold through this move here has been deflationary. So with gold going down over the last couple of years and the dollar going up, but the dollar going up has been really more recent. These are deflationary trends. So this is not saying inflation yet. This is saying deflation. So, and this is a pretty strong move. So I don't think you're going to see. I don't think it's going to go immediately from deflation to inflation. I think that transition will take a fairly long time. So I'm not so sure we're through seeing deflation yet. The reason I say that, let me explain why I say that, because let's pull the S&P 500 up. Can anybody see any deflation in this trend here? No. I think the stock market is probably the last market to really have not suffered from any deflation. I mean, look at oil. Let's look at USO. Look at oil. Look at this. This is a huge move. This move, I mean, oil is probably the single largest commodity in the entire world. And look at this move. This move in the last, since, what is this, mid-June. Since mid-June, oil has, from top to bottom, went down almost 11.5%. That is an enormous move for a commodity. Now, before you say, well, that's not possible or whatever, Look at the move it made in 2008. So, are we on track for another one of these moves? I have no idea. But it's certainly possible. If you get a huge rise in the dollar, you could certainly see oil move. That's hard to believe. It says it's a 96% change. I'm not sure oil actually went down that much. We'd have to go back and look on the actual futures chart, because the USO is an ETF, and sometimes ETFs don't show you the real value. So don't put too much faith in that. But you can still see that oil dropped a lot. So I think that's the point there. Let's go back to the Dow Jones, and let's look at just the last 9 months or so of the Dow Jones. And then what I want to do is I want to put on the RSI. And you can see here now, oscillators, some people think oscillators are great, it's the holy grail or whatever, but what this RSI shows you is it shows you kind of momentum in the market. And so what you can see is that the market, first of all, had a lot of momentum here starting on October 20th and ran up into this oversold zone. So anything greater than this 70 is oversold, and anything less than 30 is overbought. So anything greater than 70 is overbought, anything less than 30 is oversold. But you can see here we've been overbought since October 30th. So, the market can stay overbought for some time, but clearly it's overbought. You might be able to go back a year and not see an overbought condition quite like that. Well, we are looking at a year, so, overbought doesn't stay overbought for very long. You can see here it was overbought. If we go back, let's just go back 2 years. See, this is the most overbought that it's been in the last 2 years. These were pretty overbought areas here, but nothing like this one. So that tells me that there's a lot of risk in the market. Certainly, if you had new money that you wanted to invest, you would not put it in right here. You might wait until you see, the market come into this lower area on an RSI. This is the RSI Wilder, for those of you that use charts. I don't know if we showed the UK. I better go back and show the UK. I know Chief Storm over there, he likes for us to look at the UK. We did look at this because I talked about how this looked kind of like it's a channel, but the channel seems to be narrowing, and maybe we might get, a test of the underside of this channel, and maybe it might go through it. We don't really know. So right now, there's a whole lot. Nothing looks very clear to me in the market, except that the U.S. markets are very, very strong and very, very overbought. So we're not likely to see anything next week with Thanksgiving being here, Thanksgiving in the U.S. So I think it's just going to be maybe a do-nothing week. You might see a little pullback and then maybe a new high again. We'll just have to kind of wait and see. But somewhere out there looming, remember, I don't know if you remember, but we talked about how these areas of support and resistance go from swing to swing. So here's an area of resistance from this swing up, and here's an area of support from this swing down. Well, how many swings do you see in this move? None. What does that mean? That means when this rolls over, the area of support for the move down will be down here. So just be careful, especially if you got new money and you're trying to put it to work here at the end of the year. You get a bonus or something like that. I mean, we could still go higher, but without any kind of pullback. I mean, what would be healthy here is if we got a pullback into, into this area and then bounced. But the problem right now is there's no swings anywhere. I mean, the thing that most resembles a low that we could pull back to is like a support area around this 2,000 area on the S&P 500. So if you got money in, keep it in, obviously, because there's a lot of strength in the market, and the market seems to only go one direction, up. If you got new money, you might want to wait until we pull back a little bit to put the new money in. Okay? Forward the YouTube link to your friends and family, Middle Class Investor. All they have to do, or you can just tell them, hey, go to YouTube and search for Middle Class Investor and look for that red and black chart. Also, after I record the shows, I usually tweet them to Twitter, and you can follow that at the @ Investor Class, or you can probably search too on Middle Class Investor. Anyway, that's it for this week, guys. Thanks a lot for coming in and listening. I appreciate it. Subscribe, tell your friends about it. Have them subscribe. Tell them a little bit about what we're doing here. We're not giving investment advice, but we are trying to keep an eye on the broad market so that your IRAs, 401ks, and things like that remain, at a level of risk that's acceptable. Okay, that's really the goal here. Don't get wiped out. That's the goal. Okay. Thanks again, everybody, for coming in, and we'll talk to you next week. Bye-bye.